In the first part of this video, we uncovered how the quality minus junk factor, or QMJ, identifies high-quality stocks that consistently outperform their weaker counterparts. But there's a surprising twist that most traders overlook. Some of QMJ's strongest returns happen specifically on Mondays. In this second part, we're going deeper. I'll show you how the QMJ factor interacts with the so-called Monday premium, a behavioral anomaly observed in global markets. You'll learn how this weekly timing edge can be used to boost your returns in both short-term trading and long-term portfolios. We'll also get hands-on with tools like Python, QuantConnect, and Alpaca, so you can see exactly how to build, test, and automate your own QMJ strategies around the weekly cycle. Whether you're trading stocks, managing factor exposure, or just looking for a smarter entry point, this part is packed with actionable ideas to take your strategy to the next level. Let's get started. To summarize how a trader or developer can approach QMJ. Backtesting. Use historical fundamental data to form quality scores, then simulate a long-short portfolio. Ensure to update fundamentals only at known announcement dates to avoid look-ahead bias. For the Monday effect, align rebalancing at weekends. Programming. In Python or R, use data frames to compute scores and generate signals. Libraries like pandas, stats models, for regressions, and quant tools, e.g. PyFolio, AlphaLens, help analyze factor returns. For more systematic backtests, tools like Backtrader, Zipline, or QuantConnect, Lean Engine, can simulate orders and slippage. The QuantConnect community notes that fundamental data may require custom downloads, e.g. from Quandl or FinHub, because some platforms focus on price series. Execution. If trading live, one could use an API to a broker or exchange. For U.S. equities, brokers like Interactive Brokers or Alpaca have APIs that let you retrieve fundamentals and place orders. For crypto, use exchange APIs, Coinbase Pro, Binance, etc., or libraries like CCXT. Set trade logic so that, for instance, every Friday the algorithm ranks stocks by quality score and sends orders to buy the top decile and short the bottom decile for the coming week, or month. Track real P, L and factor exposure metrics, maybe by projecting portfolio onto market, size, value factors to see neutrality. Risk management. Because QMJ often involves shorts, consider margin and borrowing costs. If the portfolio is long only, just overweight quality, avoid shorts. You lose some hedge benefits but eliminate short risk. In that case, one might simply buy a quality-focused ETF or mutual fund and perhaps overlay further weight tilts. Always stress test the strategy across market regimes. For example, test performance in the 2000 tech bubble, the 2008 crisis, and the 2020 COVID crash. Interestingly, Asness et al. Noted quality outperformed in the crisis, since junk stocks were the worst performers, which suggests QMJ can act as a hedge against risk-off periods. In terms of actionable insights, retail traders and quant developers can start small. One practical way is to mimic QMJ in a spreadsheet or Python notebook using past data. For instance, download the constituents of the S&P 500 or Russell 1000 in their trailing row, accruals, debt ratios, etc. Compute a simple quality score, say, average rank of ROA, earnings growth, asset growth, minus rank of leverage. Form two baskets, top 30% versus bottom 30%, and compare their weekly returns in backtest. Check if the Monday after formation shows excess return for the high-quality basket. This simple test will give a sense of the phenomenon. One can also use Portfolio Visualizer or MATLAB to run FAMA French regressions, including a homemade QMJ factor for insights. In conclusion, the QMJ factor is a well-documented anomaly that offers a compelling blend of theory and practice. It taps into fundamental company strength and investor behavior. The unusual Monday premium adds an extra layer of timing alchemy. As I have found, combining academic findings with hands-on coding yields the best understanding. Studies show quality stocks have been rewarded in the long run, and yet exploiting those rewards can be done both on slow, portfolio, and fast, weekly swing, timeframes. The key is to remain vigilant. QMJ, like any factor, will eventually encounter different market environments and potential crowding. By using robust backtests, diversifying factor bets, and continuously monitoring performance, a trader can harness the power of QMJ while managing its risks. Whether you focus on US equities, dabble in crypto analogs, or simply improve a core stock portfolio, understanding why quality minus junk works, and when it works best, such as Mondays, can give you an edge in developing practical, resilient trading strategies. Thank you for watching, and if you liked my post, give a like and subscribe to the channel.